It's Amazon's turn in the hot seat, ladies and gentlemen. After another quarter of revenue beats and AWS growth hitting its fastest in over 3 years, the market didn't cheer at all. The reason? Well, a massive $200 billion spending plan, which is roughly $50 billion more than expected, just spooked investors and the market in the after-hours trading. Investors said again, but again, thanks, but no thanks, sending shares tumbling 11% in the after-hours trading. Elsewhere, the US dollar is licking its wounds this morning after a softer Asian session, while the dollar-yen holds just below the 157 level ahead of Japan's snap election due this Sunday. Euro and cable, on the other hand, couldn't find their footing against the US dollar after central banks there left their rates unchanged yesterday, and they are testing support levels that could decide whether the trend continues or stalls. Gold and silver, on the other hand, are wobbling. Bitcoin is testing the $60,000 support to the downside, and all of it reminds markets that everyone should be dancing to a cautious tune. So welcome to Swissquote's Daily Market Talk. It is Friday, February 6th. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
It's just another day, another big technology earnings announcement, another set of revenue above estimates, another pledge to invest a massive amount in AI and infrastructure, and another negative market reaction. This time it's Amazon's turn to get refused by investors. But the company's revenue grew 14% more than the same time last year, better than expected by analysts. The AWS revenue grew 24%, reaching about $35.6 billion for the quarter. That's the fastest growth in about 13 quarters. The profit came a touch below expectations, but overall, what triggered the 11% slump in the after-hours trading was the pledge of a huge $200 billion spending plan, which was roughly $50 billion more than expected by analysts, and that will weigh on the company's profit, obviously. So at the open today, Amazon will be thrown below its 200-day moving average and maybe below the $200 per share level as well. Microsoft is down by almost 30% since November peak. Investors particularly dislike the slower growth in its cloud unit amid massive capital being thrown at the AI tools. Meta is down by more than 12% despite revealing that AI efforts are leading to actual higher revenue, but in vain. Investors also dislike the huge investment plan here. So Google is the only company that stands out in this crowd right now. Its stock fell as much as 7% in the hours following the earnings or the spending announcement, because the sell-off was mostly triggered by their massive $175 to $185 billion spending target this year. But here, unlike other places, investors rush to buy the dip, and the stock closed the session just 0.60% lower than it started. So that was amazing and impressive performance. I believe that was because the 48% growth in Google Cloud came as an early proof that this company's TPU chips will actually make a difference in this space and potentially divert some revenue from chip sector's heavyweights like Nvidia and AMD. And Gemini will be growing its market share quite strongly with concrete and paid partnerships, starting with Apple. So here we are again. Nasdaq futures are down again this Friday morning. The US dollar is licking its wounds after a slump in Asia. Silver rebounds off $64 per ounce level. That's almost a 50% slump since last Thursday's peak at $121. Remember, that was just a week ago. Gold, on the other hand, retreated to $46.55 per ounce level before rebounding as well. And Bitcoin, oh dear, Bitcoin is getting hammered along with the technology stocks this week to levels that many thought not possible anymore. The coin shortly plunged below the $60,000 per coin mark overnight. We are now well below the $70,000 support that many experts were pointing at as a support level. That level was stood for the average cost of mining Bitcoin, remember? And the thinking was that because Bitcoin is considered a commodity, its price wouldn't fall below the mining cost. Well, that theory is being thrown under a bus at the current sell-off, and I'm afraid to say this, but no one has a convincing or a concrete answer to what would be the real bottom in Bitcoin. The reality is that the bottom will be determined by appetite for this highly speculative asset with limited use cases. Michael Burry, for example, says that this sell-off could lead to a death spiral, but Michael Burry is a dramatic man and probably a sad man who likely closed his hedge fund right before the technology sell-off begins. But realistically speaking, this sell-off will be a reminder for investors that Bitcoin's multi-year long, one-side-only trend is no more. Bitcoin could lose value as well, and it is a volatile and a risky asset. Hence, we might see especially institutional investors get cold feet from the latest move here. And one more thing before we move on. In the absence of most fundamentals, especially on the demand side, Bitcoin's price is very, very sensitive to technical and psychological levels. And those levels say that the coin is now in the bearish consolidation zone and will likely remain under pressure below the $80,000 to $82,000 range. Voila. Elsewhere, the US dollar was surprisingly better by yesterday in the face of quite ugly job numbers from the US. US companies announced the biggest number of job cuts for any January since the post-global financial crisis recession of 2009, according to Challenger. More than 180,000 jobs were lost last month. That's a 118% increase from a year earlier. And hiring intentions fell as well. They fell 13% to the weakest levels for any January in the company's 17-year record. And Amazon, UPS, and Dole were apparently responsible for almost half of these job cuts. So it was partly AI, but not fully. In all cases, this week's incomplete jobs figures from the US continue to point at the same direction. The US jobs market is weakening. It would be interesting to see the official jobs data today, with a loss. Another partial government shutdown will prevent us from getting another perspective to the darkening picture. What's sure, however, is that the US labor market is calling for Federal Reserve support if inflation allows, of course. So that data is due next Friday. Elsewhere in the FX, the euro-dollar failed to reverse losses and failed to hold ground below the 118 psychological mark yesterday, even though the European Central Bank left its policy rates unchanged yesterday, and Christine Lagarde said that the euro area economy remains resilient and that the outlook is broadly balanced. She didn't offer any guidance about what to do next. She downplayed the euro's latest strength, but she warned that risk from tariffs persists. Nothing we didn't know here really, so the euro-dollar's direction will likely be determined by the US dollar leg. Across the channel, the Bank of England also maintained its interest rates untouched yesterday, but the vote there was again very, very tight that traders ramped up their bets that the Bank of England will be cutting its interest rates in March to 60% and in April to 90%. Cable fell as a reaction and is now testing a major Fibonacci support, which is a 38.2% retracement level on November to January rise that should, in theory, distinguish between the continuation of the positive trend here from a return to the bearish consolidation zone. And last but not least, Japan is headed into a snap election this Sunday. The dollar yen is stabilizing a touch below the 157 level this morning. Remember, the stakes are high for Sanae Takaichi. She is willing to consolidate her political power and clear the way for her aggressive fiscal spending plans, partly in defense and technology, to boost growth in Japan. A victory would therefore boost equities, especially defense and technology names, weigh on JGBs and the Japanese yen. But there is a catch for the yen, because any move toward 160 level in the dollar yen would sharply raise the risk of FX intervention and quickly kill the party there. If Takaichi loses, however, the story flips. Fiscal ambitions stall, equities will likely lose momentum, JGBs catch a bit, and the Japanese yen may strengthen, with the dollar yen potentially drifting back toward the low 150s. So all eyes will be on Japan this weekend. Japanese will decide. But this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.